All right. Good afternoon, everybody, or good evening almost, right? Welcome to the NIBA conference. It's a 152nd conference. My understanding is that this has not been going on for 152 years. They just have multiple conferences a year. But I don't know, maybe it is. First of all, I'd like to start by thanking Jim Hawk, Emily Foshi, and the entire NIBA board for putting together an excellent conference, and looking forward to this evening and tomorrow. If you've ever been to one of these, then you know how great it is and the types of people you can meet. It's unparalleled almost. So thank you to everybody for that. My name is Rajiv Radia, and I'm a partner at Whiteford, Taylor & Preston. We're let's call it a regional or mid-sized firm with about 200 attorneys up and down the East Coast with 14 offices. And we're a full-service law firm. My practice focuses on securities and capital markets transactions, advising both emerging growth companies and established public issuers. Earlier this week, it's an exciting time for us, we actually announced the formation of a public company advisory group, which brings together attorneys from across our firm with various experience and expertise who work with public companies. So we have tax, obviously capital markets, myself, intellectual property, etc. And so with that, I'm excited to moderate today's discussion on how companies can navigate changes in the listing landscape and explore new pathways to the public markets. I'm joined today by a terrific group of panelists who bring perspectives from investment banking, legal, and strategic advisory. So I will go ahead and introduce Rob Hackel first. He's the Chief Operating Officer at RF Lafferty & Company, where he works closely with emerging growth companies and institutional investors on a wide range of capital markets transactions, including public offerings and private placements. Rob is also a member of the NIBA board and has been deeply involved in supporting the investment banking community and the broader small cap capital markets ecosystem. Next, I'll introduce, round of applause for Rob. Next, I'll introduce Leslie Marlow. She's a partner at Blank Rome, where she focuses on securities law, corporate governance, and capital markets transactions. Leslie has extensive experience advising public and private companies, as well as investment banks on complex financing transactions and public company regulatory matters. And last but certainly not least, Robert Wotczak, is the Chief Executive Officer of BCMA Group, where he works closely with companies preparing for capital raises and navigating the public markets, helping issuers position themselves effectively with investors and the broader capital markets community. Round of applause for Rob. So originally I was going to just throw questions out to a Rob and let them fight over who can answer it. But I decided to maybe refer to them as Rob H and Rob W, so we can avoid any fights on the stage here. All right, so with that, let's jump into the discussion. Over the past year, there's been a great deal of conversation around exchange listing standards and what those developments may mean for emerging growth companies. Rather than viewing those changes purely as constraints, today's discussion is really about how companies, investment banks, and advisors can rethink capital formation and unlock alternative pathways to the public markets. So to start us off, Rob H., let me start with you from an investment banking perspective. How are the recent listing standard discussions changing the way bankers think about bringing companies to the public markets?
Well, I think, and with that, in regards to how you take companies public, I think with the changes with the listing standards from NASDAQ and New York Stock Exchange, Amex, and what you're seeing, there's a lot of different ways. In the last few years, a lot of companies that have gone public have gone traditionally through the IPO route, and now what you're seeing is a little bit of a pivot from the IPO route to maybe reverse takeovers. You're seeing some more direct listings. You're also seeing SPACs are starting to become back in favor where they were in favor back in around 2020, 2022. They tend to have a little bit of a downturn in regards to companies going through the SPAC route, and that seems to be picking up right now, and you're seeing, seeing additional changes happen. I think it's positive for the industry because it's giving broker-dealers additional arrows in their quiver where they can come up with some different financing options with the companies, as well as seeing more of the investors that are interested in more than just a singular way of going public. So I think it's a positive.
Yeah, that's fascinating, and we've seen similar kind of conversations throughout as well as we're working with companies and other banks. Leslie, are you seeing similar conversations from the legal side with companies reconsidering timing or structure?
Yeah, we are seeing that a lot. We are definitely seeing more reverse mergers being proposed right now. We're also seeing a lot of companies raising money privately, trying to hold out to see what will happen on the private end. And we are also seeing more creative issuers that are already public. We're seeing them trying to raise capital right now before these new rules come into play, before the $5 million market capitalization publicly listed securities, that rule in particular, comes into play. We're also seeing actually an increase in advertising, marketing, people trying to really get their name out there and get their stock price up right now while they can.
No, it's fascinating. I think, and Leslie, I'm going to stick with you on this one, but are you seeing a fundamental shift in how companies are approaching going public?
I want to say right now, the companies that we have that are trying to go public are still sticking to the traditional, method that they were going. I'm not seeing that shift yet on the companies that are already in the public market. But what we are seeing, like I said, is the issuers that are bordering on maybe not being compliant with the new rules, we are seeing them consider reverse merger candidates where they weren't before.
Sure. Yeah. I mean, I think there's a lot more creativity that's going to be required going forward, it seems. Rob W., you work closely with companies preparing for capital markets transactions. Are private companies starting to rethink the traditional IPO path?
I think in a lot of ways they are. I think, what happened in 2021 in our world, I think created a massive hangover in 22, 23, and 24 in our marketplaces. And by doing so, I think so many of the companies that traditionally would have gone public in that era just haven't gone public. They've raised money private, and there's obviously now a lot more private placements and private market portals that are housing a lot of these companies. But there's no doubt about the new rules that on the uplisting and IPO side, as well as the delisting side, there's no doubt about it in my mind. It impacts every single person in this room in so many ways, whether you're a lawyer, banker, advisor, auditor. For certain, the reverse merger angle, I think, is going to come a lot more into play on the companies that are falling out or could fall out, and I think it's going to create a lot more optionality for them to try to consider what their options are, because once you hit that lower threshold, you're gone, right? There's no 18-month cure period and remedies and hearings at the exchanges. You go. I know at some point we'll talk a little bit about the OTC markets and how that might play into this equation here today, but for certain, it's been I think a challenging time, but with that challenge, I think there's a tremendous amount of opportunity that we all collectively can talk about during this panel moving forward.
Yeah, no, I mean, again, so you see the theme of there's going to be more creativity going forward, and I think there's going to be a lot more preparation for companies to, really be ready to go public to the extent that they can with the rules that are, that are going to be coming out or they're already out. Rob H., from the banking perspective, does that lead to, you think this is going to lead to healthier companies entering the public markets? I mean, it seems like an obvious question, but, again, we're talking about creativity, and if there's anything that can be said for this industry and the bankers and everybody in it, we are a very creative bunch.
I definitely would agree with you on that. I think I definitely will be. I mean, if you look back around 2020, when you're talking about looking at some of the SPACs and the companies that were merging into SPACs at that time, without naming names, you had Virgin Galactic, which went public, and they were, years away from it, launching people where they were going to be putting them into space. A lot of companies at that time, went public probably a little bit too earlier, and the valuations were considerably higher than I think what you're seeing right now and how things are structured. And so I think right now, just having the ability to, slow some of that down in regards and having to pay a little bit more attention from the banking side, I think, as well as what the investors and the appetite is and what they're looking for making investments, either on a pre-public round and then going into the public round, or looking at what the exchanges want to see from companies, right? Because the exchange listing requirements have gone up, and that's causing those companies to have to firm things up a little bit, and I think that's a positive for the industry, and I think that's going to be a positive for those companies that list. I think the biggest issue that we want to have is if you list a company, you want that to be a successful company. You want them to be public, you want them to have good advisors, you want to have them good accountants, you want to have them good counsel, and good investor relations companies to be able to present a story and a narrative to the investing public and have something that's really structured nicely. And so I think the opportunity right now that we have as investment bankers is we're getting a little bit more pickier in regards to the companies that we look at, but I think that in the end that's a positive, because you're going to be able to see, companies are going to have to be a little bit more, seasoned. But there's still a tremendous amount of companies right now that are looking to go public, and there's a lot of companies right now that are looking to raise capital, and I think, we're, at least from where we are at Lafferty, we see that constantly. We're being shown opportunities, all the time, and the amount of monies they're looking to raise are still good, and the companies are still being able to access the markets and raise capital, and you're still seeing some of those numbers, the investments are still, they're a good number. I mean, there's good, good opportunities out there. There's a lot of international opportunities. We've seen companies that are in the UK, we've contacted with and had conversations with it, interviewed. We've brought number of companies number of investors, to the companies that are looking. So I think you're still going to see a lot of, the developments and the changes that the markets are going to have are going to be positive, and I think the companies themselves are going to just have to, pay a little bit more attention to how they want to do things. But I think from an investment banking perspective, the opportunity to lead those companies, explain to them what is necessary about being a public company, they're definitely reacting to that positively. So that's been a good thing for our industry for sure.
So do you think, as a follow-up, in the long run, it sounds like we're going to have stronger issuers that are going to be listing, that'll lead to more investor confidence in those issuers, correct?
I think so. I think it's going to definitely be there. I think you still have, a lot of companies over the last few years that have either raised capital or have started, and they're good companies out there. I mean, you're seeing, a lot of companies in the data center space. You're seeing a lot of companies with AI. You're seeing space companies that are there, and there's a lot of companies out there that are still having access to the public markets, to the private markets, and the public markets. So I think those companies are actually a little bit more seasoned. They are coming to us with a little bit more, like in the past, you might have a company that says, we don't want to do, let's wait to do an audit. Now we're saying, look, you got to do the audit, get these things started, begin with the end in mind. And they're reacting to us more positively about the things that we're requesting and think that they need to get done. So it's been a good experience for us, and I think it's been a good experience not only for the companies, but also I think across other broker-dealers and other investment bankers, that there's a better relationship between the issuer and the investment bankers and the companies that are raising capital and putting monies into those investments. It's been a little bit tighter, so I think that's a positive for sure.
Yeah, no, it makes sense. And Rob W., a question for you. Are you now starting to advise companies to think about the public markets as more of a long-term strategy than a first step? And you alluded to this before about there are potential alternative paths out there, right? So we're going to move to that discussion.
Sure, there definitely are a few alternative pathways for the companies, but I think Rob H. brings up a really good point here that I think we should delve a little bit deeper in. The companies, I think, strategically from a capital markets perspective, are now, I think, forced to rethink how they're going to approach the public markets. And, at the exchange, I worked at the exchange for 14, 15 years listing companies. The phrase we always use is get the company camera ready to be. And I think they're going to be forced, even from a narrative, from a board of directors perspective, from a management perspective, from an advisor perspective, and even potentially from a use of proceeds perspective, right? Now that if they wanted to maybe go public with a smaller deal of 5 to 10 million and know that they have to do 15, I think they have to think about what that use of proceeds needs to look like and how they're going to get there. Is it an M&A strategy, or what are those drivers or catalysts that are going to make that happen? And, from the bankers in the audience, and I ran Freedom Capital Markets before the current firm I'm with, I think it will foster more teamwork and collaboration, because I think, I think a big part of NIBA is syndication, right? And, if there's a company out there and maybe someone's book of business may be able to only raise 5 to 10, and someone else could supplement that book and syndicate and get it to a $15 to $20 million deal with the appropriate narrative and use of proceeds, I think that is, a strong pathway, and I think it will lead to better quality companies and better companies that are supported in the aftermarket as well, which I think is really important.
Yeah, and I think what the exchanges seem to be doing is not allowing you to put lipstick on a pig, right? They're kind of circumventing that now. You cannot, present a company and inject some capital, a little bit small amount of capital into it, and then say, hey, this is it, and then all of a sudden it just
I think
drops,
that's
right?
super fair, right? I think at the end of the day, the exchange, beyond the quantitative, qualitative, and corporate governance checkboxes that they have, they can be the judge, jury, and executioner. And I do believe, and I think it's demonstrative in the number of microcap IPOs that have happened outside of SPACs in the last 60 to 90 days. It's a really small number, almost a non-existent number, and I think it's a byproduct of the exchanges. Even when companies are going in and meeting all of those metrics on the qualitative corporate governance side, they still are saying no potentially to those companies, and I think that's a challenge that we all have to think about overcoming.
Yeah, no, I mean, look, we're all experiencing the same thing, right? Like more than in the past, we're getting a little bit more scrutiny, it seems like, from both exchanges. So, Leslie, a question for you, and moving on to the alternative potential paths for companies. What are you seeing out there from either banks or, what are you suggesting to your clients as workarounds for what's to come?
Okay, so again, the companies that are already listed and that are on that fringe borderline, we are definitely seeing them looking to finance now so that they possibly can increase the outstanding share number and the price go up. Marketing, as I said, big pushes on marketing, and M&A. We're seeing a lot of reverse merger candidates. The other thing, unfortunately, that we're seeing a little bit of is some of them actually getting ready to be delisted. And when I say that, I know that the OTC actually told me today, I was on the phone with them, that it's a 4 to 6 week process to get listed onto the QX. So, they'll hold your place on the QX if you start the process now. And for some of those borderline companies, we are seeing them start that process now. So that, if they do get delisted, they won't be waiting the 4 to 6 weeks to end up on the QX.
And unpacking that a little bit more, and I've not been in the industry as long as the three of you have, or a lot of people in this room, but I understand, OTC was a lot more, it was a little different back then, right? Like pre-10 years ago, let's say. And do you guys see us going back to that again, where companies are using that kind of as a longer-term stepping stone potentially to going public?
I think they're going to have to. I mean, I think you're going to see that, but I also think you're going to see a large number of companies that do not meet these new listing requirements that are going to be forced down there, right, onto the OTC. And then, for them, they can use probably a Reg A, offering. They're going to change. I think you're going to see a pickup on the Reg A offerings, because that will give you the blue sky exemption. You can do a public offering on Reg A. So I think you're going to see a change from those. We haven't seen that many of them yet, but I think those will increase as well.
Yeah, and one comment on the Reg A, and I know you know this already, but the blue sky exemption exists, but you still have to do notice filings. Don't forget that. If you're ever doing a Reg A, make sure that you're still notifying the 40 some odd states, I think it is, right, where you actually have to do that. But in any case, look, I think that's and Rob W., I don't know if you have anything to add there as far as OTC goes. I know we
Yeah, sure. I think, look, the OTC is not a death sentence. That's, straight up. Obviously the ID or the pink sheets, right? That's what we would call the pink sheets back in the day. That's a different animal. But the QB and the QX, there's a recent precedent. Even one of the well-regarded, boutique, small micro-cap banks, Craig Hallam, did an actually registered IPO on the OTC market a month ago called GenPost, right? Then the stock has maintained its value. They raised $7 or $8 million. The liquidity is not great in the stock. That is true. That's a problem. But like even, my past, I reverse merged, helped a company reverse merge in 2016 that had a $200 million market cap on the pink sheets and moved it to the OTCQX, then migrated it to the NASDAQ in 2019. When we reverse merged the company had a $180 million market cap. It peaked at $12.5 billion in the spring of 2025. So there are opportunities to trade on the OTC, and I think maybe some people in the room know or not, but there are changes happening in the management at OTC at the top level, and some of the, let's say, people that may have been out there that are bashing the micro-cap space in that arena may or may not be with the OTC much longer, and I do think there's tremendous opportunity there for this community to, I don't think there's anything wrong with doing an offering and keeping a company on QB or QX for a period of time, seasoning the company, let it hit its milestones and prove its worth with a few good quarters, and then when the time is appropriate, do an offering and move it up to the NYSE American or the NASDAQ. I think it's a very viable solution, and I think one that maybe with some of these changes may pose real opportunity for the folks in this room to maybe embrace that platform. I'm not here to have an OTC commercial. I know a lot of the people and worked with a lot of people through the years when I worked at the exchange, but I do believe it's a viable option and may get better for this community moving forward.
Yeah, I think that you make some very good points there. I think that what we're seeing, the theme here is, number one, creativity is going to come into play, obviously, but there's going to be a longer runway for these companies, right? Like, they're going to have to actually beef themselves up and really be ready to be public companies. And as somebody who's worked with a lot of companies who are not ready for that, I think this is actually, I think it's good news, right? I think it's going to lead to kind of a positive, it's going to be a positive trend as far as I know. Rob H., with respect to what we've just spoken about as far as OTC companies and, potentially spending more time there, how are investors viewing this in your discussions with investors that you've been
Well, I think, exactly, I think what Rob just said, which was, perfectly, we're talking about different ways to raise capital, and with the traditional IPO window kind of changing and becoming more difficult, there are other ways. So I think some of the way that the OTC markets have been looked at in the past I think that's going to change, right? Because you're going to see, hopefully, better companies going to the over-the-counter market because of the fact that they might not meet listing standards. So the ability to have an OTC company in the past, which might be might be a little bit more frowned upon than it normally would, now you're going to see, hopefully, some of the companies that get listed there that are going to, we're not listed, will be on the OTC markets, are going to be a little bit of a higher quality, higher caliber. And I think kind of the same thing. I think the idea of being a public company, you have to prepare for it. You have to make sure you have everything in, that's the most important thing, is just being prepared, understanding what it means to be a public company. And I think in regards to that narrative of what it means, you have the ability to make the job easier for the investment banks and the partners that they are going to bring to the table to raise that capital, right? So the takeaway from the public in regards to raising capital of the counter market is going to get better, because you're going to see you're going to see companies that might not meet listing standards are going to list there, and those companies themselves will be better, and I think that the investor appetite is going to increase. So I think the opportunity to bring companies to the counter markets, or that are going to be there, hopefully improve, and exactly what Rob was stating, the ability to uplist is important, right? So have that plan in mind, have an understanding of what you're trying to accomplish, not only where you are as an over-the-counter security, about what's your plan? If you want to, obviously everybody's goal is to uplist to the NASDAQ or uplist to the NYSE or the NYSE Amex, right? So what you need to do is just be prepared for that, and obviously add a little bit more time than you think it's going to take, because it always takes longer no matter what you're doing, especially when you have a government that could shut down, geopolitical risks that can occur. There's so many other things that are occurring currently that could add time to what your, the time frame that you have. So I think on the over-the-counter, we're working with a couple companies that are trying to uplist, and it's good companies, but it just takes a little bit longer to get everything taken care of. And just having the ability to narrate the story is very important. And I think that that's something that has always been the case in our industry, is the ability to tell a story, right? We're all storytellers of what we're trying to do. We bring opportunities to our clients, whether they're institutional or they're retail, and the ability to tell them, hey, look, this is a very good investment, we really like it, and this is something that we think you should take a look at. And obviously the most important thing, or what has always been said in our industry, right? You're only as good as your last deal. So you got to make sure you bring a good one if you have it. So from us, we are getting, I wouldn't say that we're getting more picky, but I think the opportunity for those companies to have those conversations is getting better. So that's a positive, I think, for the OTC markets, and it'll hopefully be a good positive for our investors as well.
Yeah, look, I think again, we're seeing the same theme, right? It's going to be preparation. So let's unpack that a little bit. And Rob W., maybe you can chime in here, but what is it from the advisory side that you're telling companies they should do to prepare better, right? We've alluded to preparation very broadly.
Right.
But what are the few things that you'd advise them to focus on now?
I think the first thing that I would say is, make sure that corporate governance is buttoned down, right? That's really important, because everyone from investors to obviously exchange regulators will take a very close look at that. And I think they need to create a realistic pathway from a quantitative perspective, if they don't have it yet, or whether they're private or if they're OTC, to get to that pathway where they're realistic about those expectations to get onto the exchange. And I think it's really important that you're judged on the company that you surround yourself with. So the advisors that are in the room with you are really critical in those decisions. And I think oftentimes if you have, unfortunately, sometimes companies get caught up with the wrong subset of advisors, and or have folks that are on their cap table that are problematic to them. And even if they hit their milestones or develop and work on their business plan works out, oftentimes it's impossible for that company to quote-unquote get out of that roach motel, right? And I think that's really critical. So when we're working with companies, we will do an immediate diagnostic of all of those types of quantitative, qualitative, and corporate governance things, and make sure that they have the pathway. Oftentimes they also need help with the CFO or change an auditor. That's really a big thing often in times with some of these companies, and sometimes those aren't easy conversations to have with the CEO and the board of directors, but it's really important. We're dealing with a client right now that's going with it, that's on the pink sheets, and they're putting up roadblocks, but I'm saying, look, you're not going to get there unless you're willing to make some of these changes. And I think that's part of the problem. Sometimes entrepreneurs that are working with these companies, they don't have the capital markets acumen, don't necessarily acquiesce to the right pathway from a capital markets perspective to get there.
Yeah, no, look, I mean, we see the same thing, and Leslie, I'll let you comment as well in a moment, but I've got clients, it's tough to, a lot of entrepreneurs in this room, and what makes you successful in your business sometimes might be a hindrance in this industry, right? So I think it's important to surround yourself with the right advisors, the people that know how to navigate and help you navigate this space. Leslie, as far as governance goes and compliance, is there anything that you wanted to add to what Rob just said?
No, I mean, I agree that you definitely need the right advisors and, the board, and I know that can be really a sticky situation a lot of times, especially when you have, people who've been on that board forever and telling them that they need to be replaced. As well as, like you said, the auditor. And in fact, the exchanges, if the auditor isn't who they're comfortable with, haven't done a lot of public companies, they will not list those companies. So it is key that the auditor be somebody who's very reputable. The other thing, I want to say is it does usually take longer than you expect. And so I think people have to be very realistic that they make sure they have enough funding to anticipate not being public right away. And I think that's often, a problem right now where people didn't plan on, or planned on going public sooner, and then they don't have the right amount of funding to last through that. So that's really crucial as well. Take money when you can get it. If you're raising private money, go for the most you can go because you don't know how long it's going to need to last.
So be well capitalized is
Very
kind of the
well
theme, right?
capitalized, yep.
Yeah. No, I think that makes sense. And look, I mean, as far as wanting to get listed quickly, I mean, how many people that are advisors in this room have heard, how fast can I get on the, get listed, right? And they think that it's going to be 3 to 6 months, which I think we all know that that's if that ever happened, that's long in the past now. So, so Leslie, I'm going to stick with you here, but if you're advising a public company right now, and you alluded to kind of a longer timeline, a company that's looking to go public, what would you have them work on and do over the next 18 to 24 months, let's say, to be ready for the public markets?
Okay, so the first thing is making sure that they have the audit underway, because audits take a long time. It's a lot easier to describe the business and write the sections of the registration statement that describe the business, but the audit typically takes a longer time. So I would tell them to get ready just in case something changes, markets open up. At that time, while they're doing that, they probably will be applying to one of the exchanges if they're looking to be on the exchanges. So they will need to get their governance in place as well, which means, looking for proper board members, making sure that they have all the committee members, audit committee experts in particular, people who understand compensation and governance as well. And then doing that hard look at the CFO usually, making sure that that CFO is capable of, being a public company CFO, and making sure that they have advisors. It doesn't necessarily mean that they can do everything internally, but that they have the right advisors on the outside, even for, preparing financial statements, using some outside services.
Yeah, look, I'm going to add to that and kind of underline, double, triple underline the get a CFO that knows what they're doing in the public markets, because I've seen that go the other way and it's not pretty, right? And people want to stick with the people they've come up with, but sometimes you need a little bit of help. Don't be afraid to ask for it. I think that's the theme. Rob W., do you have anything to add there as far as having a company? I think you may have already spoken about some of this, but anything to add?
Yeah, look, certainly the CFO is critically important, right? And again, oftentimes, and we're honestly dealing with one in real time that's, fighting that fight with us, and you're not going to win that fight, right? And, creating the realistic timelines for these companies also, I think, is really important, right? We all have had that experience, right? And you're going to have this done in 3 months, right? It's like, no, let's create a 12-month, 18-month timeline, and if you do this, this, and this, then you will put me or us in a position to walk into the exchange from a position of strength, right, as opposed to a position of weakness, and present an appropriate file and give us a fighting chance to get that uplisting done.
Yeah, no, I think that's a point worth highlighting. I think, especially with the increased scrutiny from the exchanges, right? And it's not just the quantitative scrutiny, right? It's not just the listing standards. They're also scrutinizing other factors now, governance.
It's crystal clear. Like, you don't have to be a rocket scientist to see that, before the, crisis in Iraq and U.S. and the markets were humming, right? The capital markets were humming, the indices were humming, and how do you have one or two, IPOs $25 million and under in the last 90 to 120 days? It just doesn't make sense, right? So it's crystal clear that the exchanges are, raising the bar beyond the quantitative numbers that are being put in front of us. It's no doubt about that.
Yeah, no, I think that's 100% true. Rob H., do you have anything to add on this?
Yeah, I was going to say, I mean, it's becoming more difficult for the exchanges are taking their time. So in the anticipation of how long it would be for a company to be reviewed, to get approval, be effective, those times, they're just adding a lot of time on that. When we've spoken to a couple companies and they say, well, we're looking to go public, we're going to go public in, March or April, that's our time frame. And, we're just like, look, you got to be, the other two panelists have brought up, the word realistic. And, that's important, right? So you have to be realistic. You have to understand everything's going to take a little bit more time than anticipated. The opportunity to look at a company and, if you fail to plan, if you fail to plan, you're going to plan to fail, right? So the ability to have everything lined up, have good auditors, have good partners, be able to make that compelling story and the compelling reason why you'd be a good investment to the exchanges themselves, because they're going to want to hear that as well, and being realistic. I mean, every single, not to say something negative about any of the CEOs, a lot of times when we meet with people, every CEO is not Tim Cook, and not every CEO is Steve Jobs or everybody else. Like, this is going to be the greatest company ever. Be realistic, be an understanding. You could have a great business, and the opportunity to take that business and have it be a public company, you could be a tremendous success. But that doesn't mean that, a year from now, currently we're doing $1 million in revenue, and next year we're going to be doing $3 to $4 billion, and everybody's going to be jumping down our throats saying, I love our business. You know what? That's a story that a lot of investors have heard in the past. So I think the ability to be realistic, line everything up, have everything the way that, that's going to be structured, and an understanding of what it takes to be in the public markets, and have good auditors, have good partners, as has been said. It's important, and it's really something that, I think the biggest thing that companies that want to go public look at is being public is not the end. It's the beginning of a new chapter, right? So the companies that want to go public and say, hey, get this done as quickly as possible, let's go. No, like, you're going to be a public company. The goal of you as being a public company is to be a public company not for the next month, 2 months, or 3 months, or to get the company public. You want to be a public company and be on the NASDAQ or an exchange for a long period of time. That's important, right? So we're talking about a lot of the OTCs and possible delistings and companies that went public and maybe went a little bit too soon. It's important. Take your time. Make sure that you get cap table the right way. Make sure you have the right partners, as has been brought up. And the ability to have that is going to serve the companies that are looking to go public better in the long term. And it might take a little bit more time on the short term to get everything lined up, but that's important, and that's really what we're seeing is the companies that are more prepared, have a better understanding of what they're looking to accomplish. Is becoming easier for us as a broker-dealer to bring that story to the investors, and that's what we want to do. We want to have companies work and be able to see what we're trying to do, make our job easier. Our job is, as a banker, it's never easy. There is no such thing as easy, but you want to make it as easy as possible, and that's where we need the help from the company. So a lot of the investment banks in here, and the ones that we've always talked to, it's like, hey, look, let's talk about this story. Let's talk about why you'd be a good public company. Let's talk about what it means and what you're going to try to accomplish when you're in the public markets. And building a holistic view of everybody and what it takes to be a successful public company, start that now as a private company, and that's been, it makes it a lot easier for everybody in the ecosystem of the capital markets and investing public. Makes it easier, and it's going to be better for you long term as well. So that's one of the things that, that's my opinion on that. And we're trying.
Yeah, no, look, I think that regulatory change can spur, innovation and creativity again, right? It's the same theme, and we as an industry seem to adapt very quickly, right? So Rob H., I'm gonna stick with you on this one, but for the investment banking community here, what sorts of opportunities do you see coming from these changes?
Well, I think you're seeing a lot of, as Rob mentioned, the number of IPOs that are going or happening or are slowing down. The exchanges, as we say, and the exchanges are taking their time, and there are more, different opportunities to go public are happening, right? So you're seeing the reverse takeovers. You're seeing, the SPACs are back and they're getting bigger right now, right? So there's a lot of the tremendous amount of SPAC mergers being discussed. I think on the SPAC side of life, the sponsor side is becoming easier. It's becoming small. It's becoming less of a financial burden from the sponsors to start SPACs, and it's becoming easier for them to find targets and to bring targets into them. And I think that, to get a pipe right now for a SPAC company, I think they're starting to get those, they're starting to get interest with that. So I think the SPAC market is gonna continue to be, a way to, that is a way to go public, and right now you're seeing that. That's a positive, I think, for our industry. So I think, as you're talking about, like, adapt and change in regards to, the investment banking community, or really any business, but in the investment banking world, as soon as you see kind of one door starts to close a little bit, like with the NASDAQ and the IPOs, there's still interest from the bankers and from investors saying, okay, well, if that's going to close down a little bit, what else can we take a look at? So right now, you do have a lot of companies that are on the NASDAQ that are looking for reverse takeover opportunities, or looking for companies to come in, maybe some synergies to continue to meet the listing standards, as we were talking about before, in regards to the companies that are getting close to not meeting listing standards, and they're starting to look at alternatives and things that they want to do with their business. I think going back, if you went back 6 months ago, about a year ago really, but a year ago to 6 months ago, you saw a lot of DATs, digital asset treasury companies, where they had crypto companies that were getting merged into NASDAQ companies that maybe were also looking for other alternatives and other things to put into their business, because maybe their business wasn't doing as well as they anticipated. So you saw a lot of the DATs come out, and that kind of merged in, and that has been, that was a very hot trade for a long period of time. It was very easy to get investors into that. And that has slowed down as well, right? So in the last 6 months, the digital asset treasuries have not been something that's been looked at, that can be merged or looked at into a NASDAQ company, which is great for companies that want to actually be an RTO and now go back into the NASDAQ shell. So you have these NASDAQ companies that are looking for opportunities from other companies that they can merge in, obviously, or possibly be complementary to their businesses, or they're looking to have that company come in, they can bring on their own management, maybe they get a couple board seats, and then take that business that's currently in that NASDAQ vehicle, currently a NASDAQ public company, and maybe that gets moved out, merged out, or might go to the OTC or get sold off. So I think you're starting to see that the reverse takeovers and the SPACs are kind of coming back, and I think that's going to be, that's going to be a trade. I think that's going to be around for a little while at this point, especially with the NASDAQ and the New York Stock Exchange, Amex, with what they're doing in regards to listing qualifications and how long they're taking to look at things. So I think that those are two areas that are going to be looked at, and along with the OTC as well.
No, thank you for those insights. Those are actually very pertinent to what we're talking about here, and the creativity, again, right, comes back in as the theme. Leslie, I'll switch to you on this one. Do you think, are you seeing actually, what Rob just talked about, right? Some of the different structures. Are we seeing more sophisticated structures or creative structures yet, or is that something that you're kind of, it's kind of teetering right now, and then potentially in the near future?
I think we're going to see it in the near future more than we are seeing it right now. I mean, like I said, right now we're seeing a few reverses, but standard reverses. Maybe companies that wouldn't have looked at a reverse a year ago, but they are now because of the requirements that they don't think they'll meet. But we're not seeing anything really unusual yet. More SPACs, like you're saying, more talk of SPACs. Not really seeing that yet, just a lot of talk of it coming back again. We are seeing more pipes in the private companies, though, trying to raise, again, more money, knowing that they probably are not going to go public yet, and holding that off. I think we're also seeing some of the VC firms that are investing where they thought they were going to come out earlier. They're not. They're going in for another round where we weren't seeing that earlier. So, I mean, those are the changes I'm seeing so far.
Rob, are you seeing differences, or at least, investors who are, what's the word from investors on things like this, right? Like, are they hesitant to jump into a private company right now because of the potential that this company may not be able to get listed on NASDAQ or NYSE?
That's always the concern, but I do think what we're going to see with respect to change and adaptation here moving forward, this vintage of SPACs, I think, is here to stay, and here to stay for a while. I think there's a glut of private companies because so many have not chosen, for whatever reason, not to go public over the last 2-3 years. So the SPAC sponsors and people that are out there, I think the equilibrium in the market for those types of companies to merge into SPACs is very strong. So I think that's why you're seeing the uptick in SPACs. And I think you'll also see, I believe, a lot of these I'd say more mature companies that may want to be public, maybe take a closer look at the reverse merger angle here, because with the new rules, you're going to have a whole now litany of, all if you do is a search of NASDAQ, 10 million and under, it's a big number, right? And so those companies, frankly, are DOA, right? Most likely, right? They're not going to go from 8 million to 300 million, most likely, right? So, and with those new rules, they're going to have to create strategies, and I think the companies that, particularly if there's an adjacency to that company for what the private company does, I think that's a real good opportunity to have some reverse mergers. And I also think that what's happening in this market and with the new rules, I think it might foster more earlier M&A with some of these private companies and into some of these public companies to get themselves scale and position to do that. So again, I really think that, sure, that these rule changes are here, but I do believe there's tremendous optionality and a tremendous amount of opportunity that will be born out of all of this.
Yeah, go ahead, Leslie.
Yeah, one thing to add, that, what you're saying means that the companies that are private have to also be ready, right? And that's one thing, if you don't have audited financials, that can blow a whole deal and you can lose an opportunity. So we're seeing companies getting ready, and when I say getting ready, getting those audited financials earlier than maybe they would have in the past.
For any of the private companies that we talk to, work with, and/or advise, the message is the same, but it's more pointed today. It's act like a public company today. Do whatever you need to do within your construct to act like a public company, because you don't know when that opportunity is going to come knocking on your door. You might think you're going to go public in 12 to 18 months, but maybe there's a SPAC opportunity that knocks on your door, and it's a compelling opportunity. And you need to be nimble enough and ready enough, because if you're not, that SPAC is just going to leave the room and go to the next one, right? You have to be, I think, be as camera ready as you can, as early as you can, I think is the best advice that I think all of us could give to, prospective companies that want to be public. Act like a public company even if you're not.
Yeah, look, I mean, I'm going to double underscore another point that Rob just made right now, right, is get ready, because you may miss an opportunity, right? The last 3 or 4 years since that boom that we saw in 21, 22, just going into 22 a little bit, since then, it's been up and down, right? You don't know what's going to happen, especially with the last year and a half or so. There's a government shutdown, the market's up, the market's down. There are different things that are happening. So, if you're not ready, get ready. And what does get ready mean? Well, lean on your advisors, right? And that's the people that are out there. Talk to as many people as you can, find out what getting ready means, right? I think we're bumping up against time here, so I'm going to ask a closing question to each one of you. If you had one piece of advice to give an emerging growth company thinking about going public in the next few years, what would that be? And I think I can guess what each one of you is going to say by what we've already talked about, and I've underscored all these points, but we'll leave you with these thoughts. Leslie, you can go ahead first if you want to.
I think the thought is get ready, exactly what you just said. I mean, really be ready, because you never know when the window opens or an opportunity is there, and if you're not ready, you're going to miss it. Especially now. There are so many companies not going public that there's much more competition for those good opportunities.
Yeah, look, there's a lot of great advisors in this room. Lean on your advisors, and, again, you don't know when that opportunity or what pathway. You might think, I'm taking this company public and doing a traditional IPO, and that reverse merger opportunity, or that SPAC opportunity might come knocking on your door, and if you're not ready, you lose that opportunity, and you may only get one shot on goal there. So I think it's really important.
I think the most important thing is no shortcuts. Right, so it's the same thing that everyone's we're talking about here on the whole panel. It's just understand, be prepared, get ready. Understand, everything's going to take longer than you anticipate. Things come out of nowhere at the last minute. You have no idea. We were planning for this panel, and we're talking about a couple things a few weeks ago, and we're not talking about the U.S. invading Iran. That was not on our bingo card of what we were going to be talking about, but all of a sudden it is, right? So these are things that you have to deal with. You have, issues. You have SEC shutdowns. You have SEC partial shutdowns. We've had to deal with that when we're talking to companies about raising capital, and we're talking to they're saying, hey, we got to hurry up and get this done right now because we don't know what's going to happen, when the next shutdown's going to come. That's, before the, going back a few months ago. So I think the idea is just make sure that if you're looking to just be prepared, don't take any shortcuts, and the last closing thing is if you're a public company or a private company, and you have one job as a CEO, if somebody offers you money, you take it. That's what it comes down to.
That's an excellent parting thought there, Rob. I like that. Well-deserved round of applause. Look, we're just about at time. I think they might be setting up alcohol out there. I do not want to stand between this crowd and that to the extent that you drink, but there might be some food. I'm not sure. But thank you all for joining us. Thank you to our panelists over here. It's clear that changes in listing standards are spurring creativity, and we all have to become a little bit more prepared and ready. So talk to the people outside. Thank you all for joining, and have a good rest of the conference.